Okay, so the section that we're now in is titled apportionment of input VAT, basically. So apportionment is quite a critical topic in its own unique self, because it deals with like apportionment that relates to input VAT having to be recognized or processed, and it's obviously given rise by situations that would likely be as a result of the actual structure within which we've got like a business operation or a company for that matter. So for instance, say that we've got a company that is making partly taxable supplies and partly exempt supplies. So say on the one hand it's making 60% taxable supplies, and on the one hand it's making 40% exempt supplies, and in the process it basically purchases like an item which is taxable in nature. Maybe let's say an item like let's say a shredding machine, for instance, or let's make it a computer for just like easy understanding, like to basically have like easy kind of like an easy demonstration, if you can call it that. So 60% taxable supplies, 40% exempt supplies, and it's a computer. And computer, in its nature, it's a taxable supply in its nature. So let's say this computer gets to be used in one of our departments, which basically deals in making exempt supplies. And that computer in its nature, it's actually a taxable supply, but because it's used wholly in a taxable, in an exempt supply department in its entirety, like 100% of the time, that computer is actually working within a department that makes exempt supplies, holistically. So therefore that computer, over and above the fact that it's taxable in nature, but because it's functioning within a department that makes exempt supplies, therefore there would not be any VAT claimable on that actual computer. Then take the very same computer in this company of ours that is partly making taxable supplies, and we're now taking it to, let's say we taking it to a department which is making taxable supplies, and that department uses the computer holistically and wholly for its use within this taxable supplies department. In that situation, that computer can then totally be deemed to actually claim 100% input VAT, because it's working within a function which is basically utilizing taxable supply in nature items. Whereas we take, sometimes this computer will basically not be in a department that holistically uses it for one function or another. It's like it gets to be moved around. So in that situation, this computer now would likely have to claim VAT to a certain extent. So in the past, many people would have maybe gotten into that situation, and they would have realized that the business that they're dealing with is making taxable supplies of 60% and exempt supplies of 40%, and they would have maybe taken that asset, and wherever that asset was basically functioning, they would likely have applied the taxable supply portion, which is applicable to the actual business as a whole, in terms of making it like claiming VAT to that extent. But no, that would totally be wrong. It's not always that clear. So you have to look at how the actual item is actually used and for what purpose as well. It could likely be used for an exempt supply, it could likely be used for a taxable supply, where the principle of applying the apportionment of the actual business of 60 to 40 is irrelevant in that situation if it's used in its entirety for whether taxable supplies or exempt supplies. So that would be irrelevant in terms of applying the business apportionment. Whereas this asset could likely find itself where it's not like a clear-cut cause in terms of how it's used, then you therefore have to work out like an applicable like rate as to how we can basically claim input VAT for such an asset. And in most cases, this relates to your general use assets and your general cost as well. That's what you'd likely be able to claim, input VAT for as well. So there are two formulas in practice that would also be a framework in which we have to basically use the actual applicable rate. We'll talk about those on the whiteboard, and basically we'll get into an example that would like to elaborate as to how we basically get ourselves into one such situation. And that's what we'll be very much aware about in terms of where we are in using the actual principles of working towards getting an applicable rate. There are two methods used in practice. The one is called the input-based method, where there would be inputs that would likely be given to you, and it would be VAT. VAT. It would be based on VAT, which is attributable to taxable supplies. It would be VAT which is attributable to taxable supplies in nature's VAT value over the total VAT value. So that would be the input-based method, whereas the other method is like called the turnover-based method, where you'd have to use total taxable supplies over total supplies, and those two figures would have to exclude VAT. But we'll talk more about elaborating on that on the whiteboard there. But our main focus would likely be based on the turnover-based method, because that's the one which is mostly used in practice, and it entails you to basically inquire of a few processes of getting to that applicable rate and getting to understand as to how you get there. You need certain values of cost that you have to apply to the turnover-based method, and it doesn't allow values that have to do anything with your ICAs. It excludes values that as well that also relate to your capital in nature assets as well, and it also excludes one more value which would have been like a denied supply in nature item as well. So that bottom line in terms of the total of the turnover-based method, in terms of that fraction where you had your total taxable supplies over all supplies over total supplies, would basically be making reference to those exclusions not being made part of that line, where you'd not be able to include your capital in nature items and your ICA's value as well as your denied supplies. Would likely be wanting to get values that are basically like your taxable supplies, your zero-rated supplies, and your exempt supplies as well. That would be likely transactions that would have likely happened within the normal course of business basically. So that's basically where we are. We'll follow this up with a few demonstrations, and we'll come up with an example so that we basically dissect this and we'll take it further as well.